Fundamentally, I think it would be fair to say that clients' needs and wants haven't changed since pensions freedom came into effect. The reality is their needs remain exactly as they were. They need an income for life, ideally. However, their wants have changed because of pension freedom. So we're seeing more and more people taking out lump sums from their pension funds and then potentially putting that into their bank account, which generally speaking an advisor wouldn't be recommending as a course of action. We also need to acknowledge that actually meeting a client's needs, their base level physiological requirement for an income to support their essential spending, their physiological needs for a home and a roof over their head and to be able to heat the home. That's the bottom line need for a client. And generally speaking, until they've met that requirement, whether that's through a lifetime annuity or a fixed term annuity for a period of time, they won't be able to adequately focus on the next bit up, which is, you know, the holidays and the enjoyment and so forth. And we can actually go back to 1943 and Maslow's theory of human motivation as a source for that. So fundamentally, needs haven't changed, but wants have. And that's the massive challenge for the advisor, to meet the client's needs whilst acknowledging their wants. The whole concept of blended retirement solutions really has come about as a result of pensions freedom, and the regulator has highlighted the fact that people are going to want to have solutions that may not necessarily remain the same throughout their entire retirement. So actually the concept of blending is the idea that you can segregate out the income requirement, not necessarily for the entire life of the client, but for a specific period of time to fit in with potentially other pensions that come into payment. The other critical thing with blending is that if a client is taking money out of an invested fund and that invested fund is falling in value, you're getting effectively pound cost averaging in reverse, and that can be incredibly detrimental to a client's long-term retirement needs and requirements. So allowing a part of the retirement portfolio to grow for a period of time without the problems that drawing an income from that investment potentially can generate is why blending now has become a really advantageous way for, you know, the majority of clients to consider their retirement planning needs. Now, high net worth individuals probably still go down the route of 100% drawdown, but they have the capacity to potentially draw income from other sources and therefore potentially turn income requirements off in periods where the market may turn down. Pensions flexibility is a massive change for clients, and in particular since April of this year, the ability to pass both crystallised and uncrystallised funds onto dependents and other beneficiaries is actually a key part of intergenerational pension planning. So historically, people have tended to think that they should take their money out of their pension as soon as possible. Actually, the reality now is that clients should be thinking about leaving as much money in their pension fund as they possibly can, drawing income from other sources, ISAs and so forth, and in particular, if they're looking at making nominations in favour of their children and grandchildren, it's vitally important that they keep the nominations up to date because it will otherwise potentially limit the options available to them, in particular for wealthy individuals where the member may wish to divert funds past a wealthy spouse towards the next generation. Without making nominations in favour of non-dependents, the scheme administrator cannot make flexi access drawdown available to those nominated beneficiaries. So it's a high net worth individuals scenario, but it's critically important that clients seek advice, not just in terms of making the nominations initially, but in reviewing and updating those nominations over time. So we've seen some really sad scenarios where clients have not been able to do what they had hoped to do by virtue of the way the legislation has been written.